In this video, I'm going to go over 5 strategies that wealthy people use to protect their assets. That way you can learn what wealthy people are doing, so hopefully you can use some of these strategies for yourself as well. Now, of course, I got to give you a little disclaimer because although I am a licensed attorney, I'm not your attorney, so if you have specific questions, please talk to a licensed advisor in your area. Strategy number 1 is to make your assets invisible. So let me show you how this works. This is you. For my male followers, I drew a mustache. In my native language, Punjabi, we call that a much. And for my female followers, I drew a braid. In my native language, Punjabi, we call that a gut. If you have a lot of assets, let's just say you are worth, hypothetically, $1 million. That might make you feel rich, but the problem with that is that also exposes you to liabilities, because now if somebody's walking across your lawn and they break their leg because they fell onto a ditch or whatever, and then they sue you, well, now they see that you have these assets that they can come after you for. And so what wealthy people want to do is they want to have this net worth, they want to have this wealth, but they don't want anybody to be able to see it. That way, if somebody's walking across your lawn and they hurt themselves, well, you are only worth $0 on paper, so they can't really sue you for anything. Well, how do you do that? And the way that you do that is you don't own anything under your name. Let me give you a hypothetical. Let's assume that you are investing in rental properties. Jaspreet Singh invests in rental properties, but the problem is if Jaspreet Singh owns the property, now my personal assets are at stake. Because if somebody slips and falls at Jaspreet Singh's property, well, then they can sue Jaspreet Singh for all of my assets. And so what I want to do is make a shield between the property and me. And one way that I can do that is to use an entity. For example, an LLC, which now says that it is Jaspreet Singh LLC that owns the property. Jaspreet Singh owns Jaspreet Singh LLC. Jaspreet Singh LLC owns the property. And now this property is its own entity. It's owned not by Jaspreet Singh, it's owned by Jaspreet Singh LLC. That way now if somebody were to slip and fall on this property, they break their leg, insurance doesn't cover it, and the judge says, you are entitled to $100 million. Well, the most that they can take is whatever the owner of the property owns. And the owner of the property is Jaspreet Singh LLC, not Jaspreet Singh. So if the judge says you're entitled to $100 million, well, the most that they can take is whatever this entity owns. How does this apply to you? You can create different entities like LLCs to own different assets. That way you can provide yourself some legal protection, but make sure, number 2, you hire smart people. There are 3 types of smart people that you want to consider investing in. Number 1 is an attorney, number 2 is a financial advisor, and number 3 is an accountant. If you have any sort of wealth, then you want to consider getting an estate planning attorney because their job is to help plan your estate. Meaning, when you die, there's a plan on what happens with your assets, because the last thing that you want is for the government to tell your family what is going to happen with your assets. So if you have wealth and you have a family, or you have a plan on what you want to happen with your assets, go out and get yourself an estate planning attorney. And as you build more wealth, there's a lot more sophisticated things that you can do even when you're alive with your estate by building trusts to now decide how to protect your assets from potential taxes and how to pass your assets along and how to build a plan for your assets. If you are investing in real estate, if you're building a business, then you can get into more specialized business attorneys, and there are many different types of business attorneys. I highly recommend you look for specialized attorneys, not just general business attorneys, as you get more specialized, because you want a real estate attorney if you're investing in real estate. You want an internet attorney if you're building a digital business. And so different attorneys are going to have different skill sets. There's going to be your general business attorneys out there that can help you review contracts and other things like that. But as you start to build your business, look for specialized attorneys that understand the law in the industry that you're looking to build in. Number 2 are financial advisors. As you start to build more wealth and you want to have some extra guidance, or you want an extra pair of eyes to give you some help on how do you actually manage your money, this is where having a financial advisor can be very handy. Now, one of the things I like to say is as you go out and get a financial advisor, don't just expect them to do all the work and understand what your goals might be. This is where it is important for you to have at least some base level of financial education. That way you can go in and help guide the financial advisor. Think of it this way. If you walk into the hospital, you have some issue with your arm, the doctor says you got to chop off your arm. What you'd want to do is get a second or third opinion. That way you have a little bit more of an educational base as to what the right plan of action is before you just cut off your arm. It's the same thing with your money. Just because one financial advisor says something doesn't mean that's the only way to do something with your money. So you want to have a base level of financial education going in. And if you want a financial advisor, this is where you want to make sure that their goals are aligning with yours. If you want cash flow, make sure the financial advisor understands that. If you want more growth with their money, make sure they understand that. So if you want to use a financial advisor, great. Nothing wrong with that. Just make sure that you have a base level of financial education. That way they can supplement and help grow your goals instead of just following what their goals are. If you're looking for a financial advisor and you have over $100,000 in investable assets, I've partnered with a company called Money Pickle. They are an advertiser for Minority Mindset, and what their job is to match you with the financial advisor at no cost. The way that they work is they are like a marketplace where they work with a select number of financial advisors, and then you fill out a quick form on their website, and then they will match you with a financial advisor who they believe is a good fit for you, and then they can get you on a call with this financial advisor for a free consultation. That way you can get a feel for how the financial advisor works before you have to pay a penny. So if you want to try out Money Pickle for free and schedule a call with a financial advisor, I got the link to how you can do that down in the description below. Minority Mindset is a paid partner with Money Pickle, so if you use them, we will get compensated, but there's no additional cost to you. And the third thing that you want to think about is an accountant, and this is especially if you have a business or you're investing in real estate. If you just have a W-2 income, there's not much tax planning that you can do. And the reason why is because you probably don't qualify for a ton of potential tax write-offs or a ton of potential tax breaks, because your W-2 income is taxed before you even get the money. So there's not too much that you can do. Now, as you start to earn more money, it might make sense for you to get on a call with an accountant just to make sure that you're not overpaying in taxes. But in general, if all you have is a W-2 income, there's not much tax strategizing and tax planning that you can do. But if you build a business, this is where having an accountant really starts to matter, because now it's up to you to pay your taxes. And when it's up to you to pay your taxes, it's up to you to decide how much is your taxable income. And the problem with that is if you do it wrong, you could end up in jail. But if you do it right, you could now pay a lot less money in taxes legally, assuming you can qualify for the tax breaks. And this is where you want to have a good accountant that can help you qualify for those tax breaks, because what a good accountant is going to do is they're going to help you plan your taxes. They're going to help you plan for these tax breaks, and they're going to keep up with what are the tax changes that are happening, because the tax laws are changing all the time. Anytime you see a new president, you see the tax laws change again. And this is where having a good accountant can help you. Now I'm going to give you a little bit of personal story here, because I have hired good accountants and I've hired bad accountants. I used to have a very bad accountant. He was cheap. What that means is I paid him a very little annual fee to do my taxes. And all he did was my taxes, kind of. He was always late on my taxes. I paid a lot of penalties and fines and just fees because he did a lot of things wrong. And then I found a good accountant because I was getting so fed up. Actually, the reason why I got fed up is because I got a call one day from my accountant in January, which is never a good thing. I'm in my office, my accountant calls me January, early morning, and he said, Jaspreet, I made a little mistake. Could you do me a favor and wire the IRS $100,000 by the end of the day today? And then he went on to tell me that I had to send an additional $18,000 to the state of Michigan by the end of the day, and that I might have to pay some penalties and interest on this as well. I was very frustrated, and so then I proceeded to fire my accountant and find a good accountant. The good accountant that I hired cost me many multiples of what I was paying previously. It cost me a whole lot more money. But number one, it saved me a lot of stress. And number two, it saved me a lot of money in taxes. Why? Because now we do what's called tax planning. And this blew my mind because I didn't realize that an accountant could do tax planning. That's why I'm sharing this with you, because I hope that you can learn from my mistakes. Because what tax planning is, what a good accountant will do if you have a business as you start to make more money, is they're going to meet with you. Ideally, at least once a quarter, maybe once a month, depending on how big your business is. And they're going to say, here's what your income is, here's what your expenses are, here's what your tax liability looks like. We should pay these estimated taxes, but there are these things happening in the IRS, and you can qualify for these deductions if you do X, Y, or Z. This way you can potentially pay less money in taxes. Here are other things that you could do to potentially pay less money in taxes. Have you considered putting some money here? Have you considered doing this? That way now you get an understanding of what your tax liability is and different things that you can do to potentially lower your tax liability. That's what a good accountant does. So if you're building a business, if you're investing in real estate, as you start to grow, please consider getting a good accountant, because if all your accountant is doing is filing your taxes, you are leaving a lot of money on the table. So if you do own a business and you're making over $250,000 a year and you'd like to schedule a free consultation, I got the link to how you can schedule a free call with my accounting firm down in the description. Yes, I am a partner with them as well. So if you use them, I will get compensated, but there's no additional cost to you. The third strategy that wealthy people follow is real diversification. This is what the majority of people would consider diversifying their assets, which we're gonna call fake diversification. You have your money in the stock market and it's diversified across a broad array of stocks and ETFs and index funds. You might have some blue chip ETFs, you might have some growth stocks, you might have some international stocks and ETFs, and maybe you're investing in some gold companies. But the problem with this is, yes, you're diversified in different types of companies. However, all of your money is tied up in one asset class, which is paper assets and stocks. And so the reason why wealthy people want to diversify away from this is because of two things. Number one is you are at risk for a stock market crash. If you start to see a major recession, you could see the broad stock market fall. And number two is all of your assets are very liquid, which means if something were to happen to you, something were to happen to your family, and now you lose full control over how your money is used, where that control starts to be diversified, which means if you make a bad decision with your money and you decide to sell your investments, it is very easy to sell. It's very easy for your kids to sell. It's very easy for your grandkids to sell. It's very easy for you to accidentally spend this money, because all you need to do is push a few buttons on a computer or call your broker and sell your stocks, and it's sold and you've already liquidated this money. So you kind of have that risk. This is what real diversification looks like. Real diversification be investing in completely different asset classes. So maybe you own some stocks, kind of like everything that we have here. You have a broad portfolio of stocks, but then you also have some cash. And then you own some physical real estate. This is now a hard asset. This is not as liquid as stocks, because to sell real estate, it's much more difficult. Then maybe you invest in or you own a business. This might be a business that you start. This might be a business that you invest in. These might be startups that you invest in. But it's a way where you're investing in companies that are not on the stock market. And generally, this is going to be less liquid than this as well. And then maybe you own some physical gold. Again, a hard asset. I'm not talking about investing in paper gold. I'm talking about investing in the physical gold. And the reason why this can benefit an investor, especially as you start to build more wealth, is now you own different asset classes, which means you protect yourself in different phases of the economy, because there will be phases in the economy where stocks do bad and real estate does good, or stocks do bad and gold does good. There will be phases where stocks do good and your business does bad. And so now you have that sort of financial diversification, but also if you were to accidentally make a bad decision and sell your stocks, will you still own other assets as well? And it's harder to sell out on some of these assets, because we've all heard stories, or many of us have heard stories of situations where people will come in and sell an investment where they don't want to. And it's very easy to do that when you have liquid assets, but it's harder to make an irrational sales decision when you own a hard asset. And this brings me to number 4, owning real estate. Now, I hinted at this throughout the video, but I want to hammer this home here, because the reason why wealthy people love investing in real estate isn't just because you have the ability to make money, which is one reason, you get cash flow, but it's also because of the tax benefits and the estate planning benefits that you get with real estate as well. So let me break this down. Let's assume that you go out and you buy this single family home for $250,000. This building, the actual house, is worth $200,000 and the value of the land is $50,000. You'll see why that matters in just a minute. Now, you're buying this as a rental property. You're not buying it to live in yourself. So now you go out and you rent this property for $2,500 a month, and that is about $30,000 a year in rental income. So this is not the money you make in profit, this is your revenue. So you make $30,000 a year, and then you have to have your expenses. And for the sake of this video, I'm going to assume that you have $15,000 in expenses. So that means that you net $15,000 after all of your expenses. So you have $15,000 in your bank account at the end of the year. This is the first benefit that wealthy people talk about, which is cash flow. And for all of you watching this video getting ready to say, well, Jaspreet, where in the world am I going to find a property for $250,000 that I'm going to rent out for $2,500 a year? You can find these properties in Michigan all day and night long that real estate investors are taking advantage of. Just look somewhere else. If you're in Manhattan, if you're in Los Angeles, you're not going to find these properties, but if you do some due diligence, you'll find other properties in different states where you can find these types of deals with not that much difficulty. So you make $15,000 a year in profit in your bank account. Now that's the first benefit, which is the cash flow. The second benefit is the tax breaks. And what that means is if you invest in real estate, the IRS tax code says that you deserve a tax write-off because your property is 1 year older, even if your property goes up in value. So if you invest in single-family real estate, what that means is you take the value of the building, that's $200,000, and you divide that by 27 and a half. So you take $200,000 divided by 27 and a half, and that gives us around $7,200. And what that means is for the next 27 and a half years, you get a $7,200 tax write-off, a deduction, paper deduction. And by paper deduction, I mean this is a tax write-off on paper. It's not actual money that you have to pay just because your property is 1 year older. So you have $15,000 in the bank account. Then you tell the IRS, hey, I have a property that's 1 year older, so I deserve a $7,200 a year tax write-off, which means your taxable income is about $7,800. This is your true taxable income as opposed to the $15,000, even though you have 15 grand in the bank. So you have $15,000 of profit, your taxable income is $7,800 because you get to take this depreciation deduction. And by the way, this number that you use is gonna depend on what type of property it is. For commercial properties, it's 39 years. For single family homes, it's 27 and a half years. And then of course you get the third benefit, which is you own a hard asset. And what that means is you own a property that you can see, feel, and touch, unlike a stock where you own a piece of paper which says you own ownership in something. Here you own something that you can see, feel, and touch. It's not liquid, which is a pro and a con. It's a con because it takes more time to sell it, but it's a pro because you won't be as likely to make a irrational sale of a property because it's a little bit more difficult to sell. And this is why wealthy people love owning real estate and investing in real estate, not just because you have the ability to make money, but because you get these benefits as well. And the fifth way that wealthy people protect their assets is through insurance. Now, I don't like talking about this because nobody wants to pay for insurance. But the reality is it is a necessity that you need in order to protect you. It's a small price you pay today to protect you against a big headache in the future. And I know insurance is expensive. There are so many different types of insurances, and it feels like there's always just a new type of insurance that you need. But I'll tell you from experience, because I have used my insurances in many different areas, if you don't get insurance, it can end up costing you a whole lot more. And let me give you an example of what I mean. I bought an apartment complex that I'm just gonna draw right here. It's on a lake. So this right here is a lake, and this apartment complex was on 4 different parcels of land. So it's one thing that I bought, 4 parcels of land, and then you had buildings like this, where there was buildings on multiple parcels of land. It was 3 or 4 buildings kind of like this. And what ended up happening is I purchased the property, I got title insurance because my attorney told me, and you need title insurance, but my attorney helped me find a good title insurance company. We go through the process, and the seller sells me the property. This property is in very rough shape, by the way. We're buying this out of a distressed sale. The seller was a hotel person who didn't know how to manage apartment complexes, got into a lot of trouble, and now needed to sell the property. So we sell the property, we go through everything. The title insurance says that everything is good in the property. My attorney says everything is good. And then about a year in, my attorney gets a letter saying that this property just went through foreclosure. That apparently this parcel of land here had a lien on it. It had a loan on it from the previous owner of the property. He didn't tell anybody, and then as soon as he sold the property to me, he walked away and didn't pay the loan, and nobody knew. And so now the mortgage company that owned the loan stopped getting paid, and then they ended up foreclosing on this parcel of land. Now you can start to see why that's a problem, because number one, I owned this property, or at least I thought I did, and then number two, because now they want their right to this property, this land, and this portion of rents. And so now I was confused as to what do I do, because I didn't know there was a loan on this property. My attorney didn't know there was a loan on this property. My title insurance company didn't know there was a loan on this property. Nobody knew except the seller. So what do? We call up the title insurance company, because the title insurance company's job is to make sure you're buying what you think you're buying and not have to deal with these types of liens. So we told the title insurance company, and now it was their job to pay off that bank, and they paid the bank a 6-figure check to make them go away, but then the bank then gave me my property back, and then things got better. But you can start to see why it was so important for me to have that title insurance, because, well, you don't want to have to deal with these things and then pay for it out of your own pocket. So look at getting insurances. Get a health insurance. Get a car insurance, get a good house insurance, get yourself life insurance if you don't have your wealth built yet, get yourself business insurance. If you own a business, there are many different levels of insurance that you can consider getting, and I get it. It is annoying, it is expensive, but it is a cost of doing business. You better get yourself some business insurance, because there's a saying in the business and the real estate investing world that if you haven't been sued yet, you haven't been in business long enough. As an attorney, I can tell you that America is the most litigious country in the world, and people love suing people for anything that you can imagine. Get yourself some good insurance, protect yourself from those future headaches. Now, if you're looking for life insurance, again, I do have a partner that I recommend. You can check them down in the description. But the whole idea here is get yourself the insurance, pay the small price today, because it can save you a whole lot of headache in the future. Let's assume that you can invest $1,000 a month into SPYD. Now, let's take a look at what the numbers will look like. Over the course of your investing career, you invested $540,000 into SPYD, and now when it comes time for you to retire, you are making